So you've got to start with actually liking the underlying asset. So if you don't like the underlying asset at all, then you shouldn't be buying it, no matter how it's wrapped. So you should start with, okay, I want to invest in this asset. It's a really interesting asset class for me. And so the sorts of assets we're talking about are where either we really like the asset, but it's not very regulatory friendly. And so a good example of that is something like affordable housing. Got really, really predictable cash flows, but you need to be able to structure in such a way that it is less regulatory inefficient, and so that's easy. And then something like emerging markets, where you like the underlying, but actually you are worried a little bit about some of the tail risk, and so therefore you partner with an organization to take out some of the tail risk. Or if it is in it, like my natural capital example, where you like the overall investment, but you would just like a little bit more certainty around the cash flows, and so therefore you parcel up something more certain with less certain. You still like the overall investment, but you find a way that it makes more sense on your balance sheet. So I think you're absolutely right. I think there's definitely been examples in the past where companies have invested in things that weren't really great assets to begin with, but were wrapped in such a way that they suddenly looked unbelievable, and in fact they were unbelievable. So our starting point in our investment committees is absolutely to begin with, do we like this investment? Do we think this is a good asset class for us to be investing in?